the fixed income funds are in news, so we will be now understanding the fixed income funds. All right. So before we start with fixed income funds, let us understand what are funds. Funds are nothing but an accumulation of money, right? They are accumulation of money for what? For certain intended purposes. For certain intended purposes. See, you can collect fund just to spend. But generally here we are talking about, let's say, a sort of investment in certain things. So you can collect funds to invest in infrastructure projects. You can collect funds to invest in government securities. You can collect funds to invest in, let's say, corporate bonds, so on and so forth. So basically it's an accumulation of money for certain intended purposes. Okay. And you are of course collecting different people's money. It's a fund, it's a pool of money. So many people's money could be involved, collected and managed by high market professionals. So see, when hundreds of people's or thousands of people's money is involved, who will manage it? Will one of them manage it? No, generally there is a expert, there is an expert company who manages these funds, and then you get the returns. So that is what is meant by a fund. Now, in fund there are two types of fund. One is open-ended and the other of course would be a close-ended fund. What is an open-ended fund? These are the ones which you purchase from the asset management company constituted by the mutual fund. So these are the funds that you purchase from the asset management company. Now, what is asset management company? It's a third party. So if let's say company X is raising a fund, X company is raising a fund, and you are person Y who wants to invest in the fund. Now you are not directly investing or buying or taking it from the company and giving the company the money. No, there is a third party involved. There is a third party involved to whom you are giving the money, and on like you, various other people Z, A, B, C are giving the money to this third party, and this third party is investing in this company or various other company or a group of companies, and the returns will be given back to you. This third party will take a cut from that particular thing, from the money that you have given them. They'll charge a small amount for doing this practice. So it is something which you are investing with the third party, not directly with the company. So what happens is, since you are investing in the third party, you can take it out anytime, give it anytime. So it is happening in the secondary market. For example, you can do it via app also. So that is what open-ended fund is. Put it anytime, take it out anytime, and a third party is involved. The other type is the close-ended fund. In close-ended fund, what are these close-ended fund? When the company wants to have certain investments from the company, from the public, for the first time it will have initial public offering of the particular shares or something. So now the shares are not in the market. They are now bringing it in the market either for the first time, or additional shares they are bringing in the market. So they are also coming in the market for the first time. So since they are coming in the market for the first time, there is no third party which you can buy it from. You have to buy it directly from the company. So if there is the same company, that is company X, what will happen is, you are let's say Y, you can directly buy from the company. Right, directly buy from the company in the primary market. This is the primary market because directly you are buying it from the company. And since you are buying it from the company, the number would be limited, let's say, and you bought it from the company, right? Now you cannot sell it to the third party, right? It is limited, it is fixed, the number is fixed, and you bought it directly from the company. So that kind of fund is a close-ended fund. Okay, but remember, when people Y, Z, A, B, when they have bought all these funds, many companies would have also bought funds. So what will happen later on? It can so happen that these funds which were bought can be traded by the AMC also. So if these shares get started trading by the AMC, then these closed funds can be or will be converted into open funds. right? Initially they were closed because bought directly by the company, but now being traded by the AMC, so they can get converted into the open funds as well. I hope that's absolutely clear. Now, why is it in news? It is in news because there is a possibility of decline of the interest rate in the near future. So probably you can also take this advice, but don't go by the advice, do your own research. Okay, so there is a possibility of interest rates coming down. So since the interest rate will be coming down in the near future, what you can do is, since now the interest rates are higher, you can now invest in fixed income, that is fixed deposits, fixed bonds, so on and so forth, at a higher rate, because afterwards the rates will go down, right? So if you do it later, you will not benefit. If you invest now, you will benefit. That is why there has been articles floating with respect to the fixed income funds. This was in your Indian Express newspaper. Okay, so there is a possibility of interest rate coming down sometime this particular year, hence opportunity for investing in fixed income funds. So let us see what are the different types of fixed income funds. The first one is a liquid fund. Now, as the name suggests, it is a liquid fund. So what will make it liquid? If it is only for a short duration, then only it will be liquid. If there is a fund which is locked in for 10 years, will it be highly liquid? Will it be liquid? No, the liquidity will be very less. For the fund to be liquid or highly liquid, it has to be for shorter duration. So as the name suggests, this fund is for shorter duration for a period of up to 91 days. And these are the safest. Why the safest? Because it's just for a shorter duration. Imagine you giving me money or an institute money or money in a bond for 15 years. Now 15 years, such a big time, and anything can happen, so much fluctuation can happen, we don't know what will happen. But giving it for just 90 days. So we can predict the next 90 days better than predicting the next 10 years. That is why the safest form, right? So it is considered the safest form owing to their extremely low lending duration. Then there is money market fund. Now money market, if you look at the definition of what is money market, it is the market where money is exchanged for a period of 1 year or less. In the same manner, the money market fund would be for a period of up to 1 year. That means 1 year or less. Now these funds are sort of riskier than the liquid funds, but less riskier than other funds which are of longer duration. Then comes your banking and PSU funds. Now banking and PSU funds are very straightforward. Here the funds in which you are investing would be invested in banking and PSU sector. So at least 80% or more of the fund must be invested in instrument issued by banks and PSUs. So now here you are certain where your money would be invested. Your money will not be invested in infrastructure product or this or that. Your money will only be invested in instruments issued by banks and PSUs. So because of it, you will be more confident, because these are high quality borrowers. A bank is a high quality borrower. You giving money to someone on the street, you don't know what will happen. But a bank, let's say ICICI Bank, let's say SBI Bank, you know this bank is going to still be there after 5 years, after 10 years, right? Now anything can happen, but generally you are more confident with the banks, with the PSUs. PSUs are public sector units, public sector enterprises. So they are high quality borrowers. Since they are high quality borrowers, so the risk of default is very less. Okay? But yes, anything can happen, but still the risk comparatively is lesser. Now corporate bond funds. Here the investment would be in the corporate sector, and that too at least 80% should be invested to companies with highest possible credit rating. You cannot invest in any type of company with, let's say, C minus rating. It has to be, let's say, AAA or AA minus, so on and so forth. So high rated companies, high credit rating companies, in them you will have to invest. Your money would be, at least 80% of it would be invested in such corporates. Then it will be a corporate bond fund. I hope that's absolutely clear. Then there is dynamic bond fund. Very interesting. So far we were seeing that the year was sort of fixed. If you are investing up to 1 year, so it can be 180 days, 90 days, 1 year. In dynamic bond fund, what happens is the mutual fund manager plays with the time. So initially you may think that the investment is for 5 years. But if the mutual fund investor understands after 4 years that now it is not going to benefit, so they may take out the money and give you the returns. So they are here playing with the time period, and hence this bond is a dynamic bond fund because the time period is not certain. Of course, it is certain with respect to the range of the year. It will not be, let's say, 10 days, 91 days that would become liquid fund. It would be 3, 5, 7 years. In terms of years, more than 1 year, but then those years would be dynamic, would be changing depending upon the market scenario. That is your dynamic bond fund. You can read this. Dynamic bond funds are debt funds that are dynamically managed. Dynamically manage the lending duration based on the market scenario. Gilt funds are very straightforward. Gilt, whenever you hear this name, understand the government is involved. So gilt funds are nothing but funds that invest in government bonds. Minimum 80% needs to be invested as per the regulation. What do we mean by gilt? See, gilt means sort of golden. So earlier, the earliest issued government bonds used to have sort of glitter at the boundary. See, it can also be called as gilt-edged security because it is the safest form. Because even more safe than the banks are the government. Because certain banks may fail, but the government, for the government to fail, it is even more difficult. Even governments can fail, but it's more safer. It's more safe. So it used to, so that way also people interpret that it is gilt-edged because golden edged because it's safest, but that was not the reason. The reason was these, bonds which were there earlier, the paper had golden outline, golden boundary, glittering boundary, gilt boundary, and hence they were called as gilt bonds, gilt paper, and the term has continued. So wherever you hear gilt, the government is involved. Remember, it's not GILT but GILT because the government doesn't have any gilt, it has gilt. Now, target maturity fund. Now, what does target maturity fund do? It does not invest in a company, in a bank, in a PSU. It targets something. What does it target? It targets an index. For example, you have index of industrial production. In the same manner, there can be Nifty index, BSE index. So it targets an index. So if that index goes up, you make profit. So it targets the index. So target maturity funds are passive debt mutual funds because it is not directly or actively investing in a company, but it is investing in the index which consists of various companies involved. Right? So they invest in underlying debt papers of index in the exact same proportion. So in different proportion, whatever proportion they the exact same proportion here means what? If you are investing in Nifty 50. So these 50 companies under Nifty, each company would have different proportion. So if you are, let's say, investing 100 rupees and 50 companies have different percentages, some have 2%, some have 3%, some have 1%. So your money would also be invested in the same exact proportion. That would be your target maturity bond. So these are the different kinds of fixed income bonds. You can utilize this time as the experts are suggesting, but do your own research. But more important than that, remember them, know the differences. It's very important for your prelims examination as well. Thank you.